Dr. Rajesh Mewara has redeemed 15 lakh rupees from his equity funds recently, and he wants to reinvest it in debt funds. So is it advisable to invest it at one go, or should he do SIP of 2 to 3 years?
Well, no, there is no need for an SIP because this money is meant to be invested in a debt fund where it is fine to invest in lump sum. So he can go ahead and invest this at one go.
Okay, but does this hold true for all types of debt funds?
Well, yes, you can invest in lump sum if you have a lump sum amount in any debt fund. See, broadly, SIP is meant to be a mode of investment for asset classes which are very volatile, which can subject you to deep corrections at a certain points in time. And the whole concept of an SIP is to avoid the possibility of investing a substantial portion of your money uh, right before a deep correction. Because if that happens, then the journey back to recover your principal investment itself could be long and painful. Forget about the returns. So that's why the idea is to invest in these asset classes in smaller amounts at different levels of the market rather than investing all or substantial part of your money at one go. But that is not the case with debt markets because they don't subject you to volatility of that magnitude that you need to smoothen out your cost of holding. So that's why there is no need for an SIP investing. And remember, as I was just saying a bit earlier, that a big portion of the returns in case of debt funds comes through the coupon payments, which accrue over a period of time, and they are really not impacted by the level of the market. So that's why it's perfectly fine to invest at one go in debt funds.